Hello, Jim here. I've been on a journey the last couple of years to learn the right way to sell options. And what's critical for that is picking the right investments. Today, I'm going to share with you a couple funds and some strategies that I think are probably pretty close to one of the best trades that you can have. So stay tuned. I think you're really going to enjoy what I have for you. Let's go ahead and jump right in. I do like to give a quick market update. The market is down today. It was down quite a bit earlier today and it's recovered some. And that's primarily because of the CPI that came out yesterday showed more inflation than was expected. I don't think this will change the way the Fed thinks. I still think we're going to get cuts later in the year, maybe a little bit later in the year, meaning instead of March, maybe we get them in April or May. But I do think that they will come at some point. And at that point, I do believe the markets will probably get a pretty nice bounce. Now, until then, I still think we're going to kind of have some up days and down days. I think we're going to trend lower. And then when those cuts occur, we're going to get a bounce. Of course, this is my 2 cents, and I could be completely wrong, but I just wanted to share that. So in the short term, through the end of January, into February, it may be a bit topsy-turvy. So, but also that could be a good time for selling, options, puts, and calls. So just keep that in mind as we head into this year, especially with it being a presidential year. So today I wanted to talk about, as I've been learning the right way to sell options on my journey for the last 2.5 to 3 years, I've gotten better, but I'm always wanting to find that trade that's both consistent and repeatable that I can make on a regular basis, maybe on a monthly basis every month to make a certain amount of money. And I'm still on the journey to find that. And with that, I believe you need to have a clear strategy, a safe strategy, a way to mitigate risk. And then something along the lines of stable pricing, meaning the price doesn't, gyrate crazily, go way up or go way down. And also you need lots of flexibility. You need to have lots of expirations. You need to have lots of strike prices and choices with, selling options on that particular security. Now, I've tried to do this with stocks and I've also done it with ETFs. And I believe ETFs are the better way to go for this. So at the end of the video, I'm going to share with you 2 ETFs that I have done some trades on this week that have worked out pretty well. One that I'm thinking that I've not traded before, that I've actually sold an iron condor, that I think could really be a potential choice for this kind of a trade. It doesn't move that much. And both of these don't move as much as a lot of stocks. So, and then, the fact that you can have less risk, I believe, with an ETF, mainly because lots of holdings. Also, you can pick up some distributions along the way, and for doing these kinds of trades, something consistently on a monthly basis, it is, in my mind, a better way to go. Now, if you disagree, please add a comment below and let me know what your thoughts are. But in a way, it automatically causes the trade to be less risky through diversification, all the different holdings that it has, and the fact that because it's a little bit less risky, just in the nature of it, you can take a little bit more risk. So the trades I'm talking about today, I actually took a little bit more risk. I've done iron condors before, but I typically have done them at really low deltas, like 12 deltas on both the call and the put side. Now I'm actually looking to take a little bit more risk and, pick up more premium, something along the lines of probably around a 25 delta. And again, I'll share that at the end of the video in these particular trades. So the fact that it's less volatile, it doesn't move as much, kind of works out nicely for something along the lines of a vertical put credit spread or an iron condor. And I'm going to focus on iron condors. Mainly because when a fund doesn't move that much, it has. We'll give an example. So say its 52-week low is 30, and its 52-week high is 40, you can create an iron condor. So you're hoping it stays in this middle band between 30 and 40. So if it goes over 40, you have some protection using the call credit spread. And if it goes below 30, you also have some protection on the down end or the downside. And what makes it really interesting is the fact if you've picked really good ETFs that you really want to own, then there's even less risk because you're fine with owning them, which I always push that to my memberships. Pick stocks or ETFs that you want to own. I personally don't deal with companies that don't make money. I prefer ETFs that, pay some distributions and that have good holdings, and they have good reviews and ratings themselves, mainly because of the management or the way the ETF is structured and run. So that's key. So it's really like an extra benefit. If it gets assigned to you, then you're okay. So there's even less risk on the downside. And on the upside, you can limit your risk. So you don't necessarily have to have the same spread for both the call and the put. You could have a smaller spread for the call since you might be taking more risk, especially if you don't own the shares. And that's what I'm talking about at this point. Not owning the shares, kind of running a trade that you could potentially be picking up a lot of money. Now, I've talked about IWM in essence before, and it's still a very good player, and it's worked out well. And I've run a lot of iron, not a lot. I've run 3 or 4 iron condors with it, and have done pretty well. So this time we're going to be talking about 2 other ETFs and looking at potentially running the iron condor on them. One of them I have run an iron condor on, and the other one I've done primarily vertical credit spreads. And neither of these, including IWM, I don't own any of them. So they've all worked out well in the past. So, and then, so the next part of the video, I'm going to talk about these trades. I'm going to share with you my planning worksheet that I share with my memberships. And as always, if you want to learn more about my memberships, details will be below. I have 2 levels. I have a $10 monthly level and a $25 monthly level. The $25 is only for up to 100 people. I think I'm right around 70 people currently. And that's because it really does take a lot of my time. It includes a weekly coaching session, usually between 15 and 30 minutes, where I sit down with you through Zoom and we discuss, any questions you might have, you can ask me. If you want me to, take a look at what you're doing and see if you might be missing anything. So I have a lot of people, and it's kind of all over the place. I have some seasoned traders that we kind of meet and talk about our philosophies. And then I have some real beginners that I have to do a lot of hand holding. So if you're curious, please take a look below. With that being said, let's jump into the next part of the video where I'll share with you these 2 particular funds that I've traded this week and how those trades have gone. So stay tuned. Let's jump into the next section. Okay, now I've got my Schwab account open to the research tab, and I want to talk about the 2 funds that I like, that I believe are good candidates for running iron condors and vertical put credit spreads. So the first one, and this is new to me. This is a fund that I haven't used as often, but something that I'm going forward, I'm definitely going to be using. So it's the Van Eck Gold Miners GDX ETF, and you can see it's got a good rating by Morningstar, and here you can see the 52-week range between 25.62 and 36. So I wrote a 27 and a 33 with the 2 shorts. So the 27 put credit spread, I believe it was 27.22. So I did do a $5 spread. And then I did a 34 or 33.38 call credit spread. So, it can move anywhere in this range. It's definitely closer to the put side, which I'm okay with owning, a couple hundred shares of GDX. So just kind of wanted to show that 52-week range. Here you can see it. Of course, that's for one day. So it doesn't really move that much. It's the high was over here at right around 38, and it seems to move up and down. Not a crazy amount, so, and then if you come down, it pays an okay dividend, not great, around 1.6%. So if you pick it up at 27, it would be probably like a 1.7 dividend, which is okay. It's not great. And then if you, so that's the new one. This is one I've just recently traded. I traded it yesterday, did an iron condor, but it's the first time I've traded it. Now XLE, I've traded quite a bit. This is the Energy Select Sector XLE, and again, good reviews by Morningstar. It's set between 75 and 93, and typically it's stayed around almost like 78 to 82 or 83. It hasn't moved very much, and you'll see that in the chart. So right now it's around 80. It did get as high as 80. It got quite high, I guess, back in September. I'm trying to see what the price was. So right around 92. But another good candidate. It doesn't typically move that much. We can go out to 3 years. And it's been on an upward trend. And like I said before, this is a ETF that I really like. It has most of the big energy companies. That's number one holding is Exxon. Then it's got Chevron, ConocoPhillips, a lot of really good names. And like I said, I've been selling vertical put credit spreads on this for a long time. I currently don't own any, so they've worked out quite well for me. So let's jump in and actually look at the trades. So again, I did two trades. We're going to come here to the bottom. This is my weekly planning worksheet. So I put this out typically on Sundays before the market Monday opening. Sometimes I will get it out as late as Monday, but it's been a long time since that's happened. And then I list pretty much anything that's expiring over the next couple of weeks. So between most everything here that I started with at the beginning of the week was expiring on 1/19/24. And I had something like, I guess, 14 or 15 positions. Now, I have had a few get assigned just this week. Last night, literally, Devin got assigned to me, and this is another energy name that I've been selling options on for a long time. And these are the first shares in, I believe, 4 contracts. So I have 400 shares of Devin now. So I spent like 20 grand, but I like Devin, and I'm going to hold on to it. I'm going to start selling covered calls on it. I also had Verizon get assigned away from me, which is okay. I may buy some more depending on what I decide to do. I'm still kind of mixed on Verizon. They have tons and tons of debt, whereas Devon doesn't have a whole lot of debt. They have good earnings and they pay a fairly good dividend. Verizon also pays a good dividend, but I also needed the cash. So I'm looking to make a big down payment on a commercial property. So I needed some cash. So that worked out okay. I might buy more down the road. So all these others are expiring a week from tomorrow. So most of them I'll probably, let let them expire, or I may close them for really cheap. And then here's the different trades that I did this week. So early in the week, I did XLE. This was Tuesday. This is in my new Fidelity account. I did a cash secured put. So again, a lot of times in the past, I did vertical put credit spread. So any of these trades can be either cash secured put or vertical put credit spreads. A lot of times, what I like to do is if I can buy the put inexpensive, like under $20 or $30, I typically will. This case, I didn't. It was a 30 delta. My trades in this new Fidelity IRA are wheel trades, so I'm taking a little bit more risk. That's why it's a 30 delta. It doesn't expire till March 15th, which is like I think a 65 DTE. And I picked up $362 on it. Here's the base, the required capital, which is the shares times the share price minus the 362.65. And it on a yearly basis, it's like a 12.8 yearly return, which isn't bad. I'll probably close it early, or if it gets assigned to me, but it's doubtful it'll get assigned to me. I believe it went up to 81 and the strike is 79. Now it might be. That's part of the reason why I decided to take a little bit more risk. I do want to own it because and I can show you here, the call premium is even better. Let's take a look at the call premium. This is GDX. Let's look at, okay, here's XLE. Here's the, from the chain, this is what I selected when I actually sold the two contracts. And it was, again, a 3.3057. But what I wanted to show you, if you just look at a dollar more at the 80 strike price, you can see it's also got some really good premium, over $5 in premium. And it was even higher at one point. It looks like it could have been as high as 6 or 7. So it typically has lots of activity and lots of premium. You can see the open volume is through the roof, almost 6,000 for the open interest, not open volume. And then the implied volatility is pretty good. So that's the first trade. That's XLE. And I'm really thinking the next trade I do, or I may change this trade. I may add turn it into something like an iron condor. I could definitely potentially do that, or do a separate trade that's an iron condor. Now I did do an iron condor. Here's GDX. I did this yesterday, and this again is in my new Fidelity IRA. It's an iron condor. The shorts were 27 and 33, so I wanted to stay between 27 and 33. And then the outer bands were 22 for the put and 38. So definitely wanted to stay between 22 and 38, which, if what I was just showing you with the 52-week spread, it's within that. And I would really be surprised if it went out, if it went beyond either, or went lower than the put or higher than the outer call or outer put, that is. Again, if it does get assigned to me, I'm okay with that. If it gets really expensive, then I probably will need to roll it up and out. So this one also expires on March 15th. You can see they were both, the put was a 24 delta and then the call was a 20 delta. So I took a little bit more risk, and I could have done more like a 36 or a 37 strike to take a little bit risk on the call side, but I'm pretty confident it's not going to get that high, but it might. You never know. The one thing about the market is that it's unpredictable. You can predict that it's going to be unpredictable. And so for that trade, and again, it was two contracts, I picked up $220, the required capital, because each of the spreads were 500. And I actually did three contracts, not two. So I got $220, mainly because it was a little less expensive at $27. But if this expires out of the money, it'd be like a 96% yearly return based on this required capital, which is the three contracts, 1,500 minus the 220, and that's how I came up with that number. And here, let's jump back into this, and I can show you what its option chain looked like. So here you can see the 27 and the 33. So anywhere between these two bands, I'm pretty safe. And again, if it goes cheaper, 26 or 25, then I'm okay with owning the 300 shares, which I think would be like 5,500 or 5,600 now, or it'd be a little bit more than that at 2,700. It'd be like 8,000, 7,000 to 8,000. I should probably pull out a calculator, but I don't have one handy here. Actually, here, I can do it right here. So it's 2,700 times 3, so 8,100. So it would require 800 in capital, which is, I've got plenty of capital in this account. My guess is it'll probably expire worthless, and I'll be able to make that 95% return. But this is one strategy. This is, one of the strategies I think that can work out really well, taking a safe fund, something like XLE or GDX or IWM. And I probably will start selling iron condors again on IWM. If it gets down to like 180, 185, I'll probably start selling iron condors on it too. And I think it's a safer way to do it. And if I can keep the DTEs smaller, then this could work out really well. Now I'm also going to look at SPX, but for now I wanted to share these trades, and I do feel like these are some good options for doing a really consistent, safe trade. So hope you enjoyed that. If you have any questions, please leave a comment. If you don't agree with my strategy or you have a better strategy, please leave a comment. Thank you, and I hope you have a wonderful week.